Namaste and welcome to today's Explainer. I am your host, and as someone who consults on the Indian markets every single day, let me tell you, today's trading session was an absolute roller coaster. It was a classic setup that trapped a lot of unwary retail traders. We saw this highly volatile session where a massive, aggressive early rally just completely fizzled out by the afternoon. So today, we're going to put on our detective hats. We'll look way beyond the flashing red and green numbers on your screens to decode the exact data points, from critical resistance levels to crucial currency shifts that really dictated today's market behavior. Let's get into it. Okay, let's dive into this. Here is our briefing outline for today. We'll be covering the fizzled morning rally, currency shifts and profit booking, nifty open interest trends, sector winners and losers, and finally, global cues and our future outlook. Section 1, the fizzled morning rally. So let's start with the central mystery of the day. The market opens and boom, the bulls are charging right out of the gate. We get this massive 171-point gap up opening, pushing Nifty all the way to 23,830. This was heavily fueled by some great global cues, but if you track the movement from there, it was basically like walking off a cliff. Instead of holding on to those gains, that momentum just totally evaporated. Throughout the opening hour, the index drifted lower into the 23,750 to 23,800 zone. By noon, the selling pressure got super aggressive, dragging Nifty all the way down to the 23,600 range by about 1 p.m. That was the absolute low of the day. Now, there was a brief, kind of choppy attempt at a recovery around 2:30 p.m. back towards the 23,700 mark, but honestly, it just didn't have the legs. It's a textbook case of morning expectation versus afternoon reality. In the morning, the expectation was overwhelmingly bullish. Everyone was incredibly optimistic because global crude oil prices had just plummeted by more than 5%, thanks to signs of progress in U.S.-Iran talks. And, as we know, cheaper oil is practically music to India's ears. But the afternoon reality was starkly different. Persistent profit bookings set in. Traders who had bought at lower levels decided, you know what, I'm taking my chips off the table. That led to this very choppy, weak trading environment that eventually dragged the Nifty to close completely flat at 23,654.70. Section 2, Currency Shifts and Profit Booking. 96.37. Keep this number in mind because it is crucial. Today, the Indian rupee actually rebounded 49 paise from its record closing low to settle right at 96.37 against the US dollar. This strong recovery was primarily driven by those easing crude oil prices I just mentioned, combined with some likely intervention by the central bank. It makes perfect sense, right? When oil prices drop, our import bill shrinks, and that instantly takes the pressure off our currency. And this creates a very specific market chain reaction, which we can actually map out step by step. Step 1, global crude oil falls over 5% due to geopolitical developments. Step 2, breathing a massive sigh of relief over the oil drop, the Indian rupee bounces back by a solid 49 paise. Step 3, the equity markets react to this fantastic macro data, causing Nifty to gap up 171 points right at the open. But then Step 4 hits. The domestic reality kicks in. At those higher, stretched valuations, heavy profit booking completely suffocates the rally, pulling the index right back down to earth. Section 3, Nifty Open Interest Trends. Now we know what happened with the prices. But to truly understand a market, we have to move from what happened to what the data tells us about the future. And for that, we need to dive into the derivatives data, specifically open interest. When we look at the open interest change for the Nifty contracts expiring on May 26th, what's really interesting is the sheer concentration of activity. Think of the data as literal walls being built by institutional traders. The call open interest represents one side of the market, and the put open interest represents the other. The sheer volume shows us exactly where the heavy hitters are placing their bets. Let's distill that complex data into some actionable intelligence. The crucial takeaway here is that the smart money has built a massive ceiling right above us. The maximum call open interest is sitting way up at 24,000, making it our maximum resistance level. But just below that, we have incredibly high call OI right in the 23,800 to 23,900 zone. This is exactly why Nifty couldn't sustain its morning gap up to 23,830. It literally slammed headfirst into that immediate resistance wall. On the downside, the maximum put open interest is clustered around 23,500, which is acting as our immediate support floor. Just as a quick refresher for those who might need it, open interest is simply the number of active contracts. An increase in call open interest indicates resistance, meaning sellers are camping out at those higher levels, just waiting to push the market down. Conversely, an increase in put open interest indicates support. Buyers are waiting down at those lower levels to catch the market if it falls. And today, well, those call sellers at 23,800 were absolutely out in full force. Section 4. Sector winners and losers. Let's zoom into the micro view now. In a choppy, volatile environment like today's, the headline index might look completely flat, but underneath the surface, there's always massive rotation happening. And the data brilliantly illustrates this divergence. Looking at the broader sectors, Nifty Realty was a clear runaway winner, gaining over 1% with some solid support from consumer durables. But on the other end of the spectrum, Nifty IT and FMCG were acting like major deadweights. Shifting over to individual F&O stocks, Samaranka went on an absolute tear, closing over 9% higher. No way, right? Grasim also had a stellar day, up 6.4%. On the flip side, though, Jubal Food took a really heavy beating, dropping nearly 8%, with PI&D and Bosch LT also suffering some pretty significant losses. Section 5. Global Cues and Future Outlook. Finally, let's step back from the intraday chop and the stock-specific action to look at the broader economic perspective. This right here is the institutional tug-of-war that dictates the underlying trend of our market. Foreign institutional investors, or FIIs, were net sellers yet again on May 20th to the tune of 1,597 crore rupees. They've been consistently pulling money out over the last few sessions. However, our domestic institutional investors, the DIIs, stepped right in with massive buying of 1,968 crore rupees. This domestic buying is literally the crucial cushion keeping us afloat. If the DIIs weren't there absorbing this foreign sell-off, today's profit booking could have easily turned into a severe market crash. To truly understand why these macro levels matter so much, consider this powerful insight from Chandrajit Banerjee, the Director General of the CII. He points out India's 3Fs challenge. He says, and I quote, "The 3Fs are not three disparate pressures. Fuel feeds into fertilizer, fertilizer feeds into food, and all three feed into inflation, fiscal stress, and household welfare." He really hit the nail on the head there. This is exactly why that 5% drop in global crude oil we saw today is absolutely critical. It doesn't just help the rupee, it eases the pressure on this entire interconnected inflationary chain. So, what does this all mean for us? We are left with a truly fascinating setup for the days ahead. We've got strong domestic buying acting as a safety net, and easing crude prices are really helping the macroeconomic picture. But as we clearly saw in the derivatives data, we also have this massive, heavy wall of call open interest acting as immediate resistance right at the 23,800 mark. So the question you've got to ask yourself going into the next session is this. With this heavy ceiling sitting right overhead, are the bears going to take full control of the market, or are the macro conditions finally ripe for an imminent explosive breakout? You'll definitely want to keep a very close eye on those data points, monitor the FII and DII flows, and above all, stay disciplined. Thank you so much for joining me on this explainer, and I will see you next time.